So, folks, this is the S&P 500 historically going back to 1870. So it's 150 years of history in the market. And say in the last century, you could say the average PE ratio across the board was around about 15, but in more recent times, it's more like it's around about 20. So you often hear people saying the average PE ratio is 20. The market was trading not that long ago, a couple of months ago, was trading at 38 times earnings. And now it's trading at 25 times earnings. So when you do the maths, it's already dropped a lot. Like people keep saying to us, oh my God, the market's going to drop, the market's going to drop. People forget it already has dropped a lot, because what affects the PE ratio is if the price drops, then the PE ratio drops accordingly. So for those of you out there thinking there's going to be a big drop in the market, well, you can tell them there's already been a significant drop. Secondly, we tend to only invest in stocks that have PE ratios of around about 10 is our average. So we're already down here anyway. So even if the market dropped another 15 points down, down to 10, we're already, most of our activity is at a PE ratio of 10. So just to put into perspective where we're at compared to the overall market.
So the market's coming down to the level that we operate at anyway.
So we're one step ahead of it.
Good way of looking at it. Yeah.
Yeah. And what tends to happen in the market is that money leaves the high PE ratio stocks and goes back to value-based investing and starts to look for the shares that we've already proactively bought. And that's why you often see, if we look at the track record of the 4x4 stocks over the past 20 years, if you look at how they perform relative to the market, here's an interesting observation over 20 years. Let me just bring this up so you can see it. So this is based on if you bought every one of the 4x4s without looking at a chart, without trying to get clever looking at a chart, without no dividends, no calls, no puts, just pure buy and hold. So you can see here, coming out of the dot-com bubble, the market recovered 26%, but the 4x4s recovered 2 times that, or almost 2 times it. Same coming out of 2008, the 4x4s, the market recovered 23%, the 4x4s 62%. So you can see that's why we do better long-term compared to the market, because we're one step ahead of the market by buying value. And secondly, we participate from the transfer of money from overvalued stocks to undervalued stocks, so we've already bought them ahead of time. So if I just bring up an overall picture, here's another interesting observation. And by the way, I'm going to pop in here. I'd strongly suggest you read Warren Buffett's latest letter. He only writes 1 letter a year to his shareholders, but it's incredibly insightful. So back in 2001, if you had bought the S&P 500, you would have paid $1,148 for 1 share of the S&P 500. And now that's trading around about $4,200. If you spent that money on all of the 4x4s, just buying either 1,000 shares of each or $1,000 worth, just an equal amount of each, you'll be worth 18,000 now. So the S&P 500 has grown 12% in the last 20 years, which is a cumulative to 66% over time. The 4x4s have grown by, on average, 71%, and which is 1,500. So it's 5.6 times better than the market. But what you notice is that initially they track the market for the first kind of 5 or 6 years, but then they pull away from the market. And the reason why they pull away, and if you read Warren Buffett's letter to the shareholders, he really explains it very well there. It's the compound effect of retained earnings. So if a company starts out life being very, very profitable, and then it retains that earnings and keeps adding it to the balance sheet, that over time increases the value of the company, and then that increases the share price of the company. So that's the hidden strength in just the 4x4 model in of itself. So even if we just did buy and hold, we've got a very strong foundation we're building our wealth upon. And of course, we don't do all 100. You know, Jeff is in there with his spreadsheet, picking out the creme de la creme de la creme. So he's looking at the best top, 20 or 30 of the 100. So his companies that he picks are going to perform better than all 100. So let me just take you to the Warren Buffett website. This is definitely worth reading.
And that graph just there, though, and it was purely just a buy and hold situation, nothing to do with anything else that we're doing.
That's a pure buy and hold graph, absolutely. So if you go to Berkshire Hathaway's website, which looks a bit ancient, what I love about Warren Buffett is he says, if you don't like the look of my site, if you have any comments about our webpage, you can write to us at the address above. So snail mail. However, due to the limited number of personnel in our office, we're unable to provide a response. So in other words, don't even bother. So if you actually look at his website, he on here, he's got every letter he's written to the shareholders every year. So if you look at his performance here, the overall S&P 500 since 1965, when he started this Berkshire Hathaway fund, has grown at 10% per annum, but he's done 20% per annum. So you might say, well, he's done 2 times better than the market. Well, in fact, he's done 120 times better than the market because of the compound interest. The market has done 30,000%, but he's done 3.6 million%. So that's actually 121 times the overall market. And if you look down, 2/3 of his holdings are publicly traded companies that you and I can buy, and 1/3 is privately held companies that we couldn't get our hands on if we wanted to. So he, in his publicly traded activity, he only holds about 20 companies, 15 main ones, and he's got 2 or 3 other smaller ones. But what he's been able to do is he's been able to turn 104 billion into 350 billion, just pure buy and hold, no call options, no put options. Obviously, yes, dividends. But just on a buy and hold basis, he's turned 104 billion into 350 billion, just on a buy and hold basis. So, and he owns a few other ones. He owns 26% of Kraft Heinz, one of the ones that's on our watch list. So that's part of his others. So he only concentrates about 20 companies in the publicly traded companies, and it represents, his fund is worth about 500 billion now, and so 350 of that is equities. So it's about 2/3 publicly, 1/3 private. So yeah, it's very well worth reading. So I'll just pop that in the chat room there.
Great idea. Thanks, Owen.
Yeah, and we're hopefully we're looking forward to go and see him live next year, May 2023. So put the first Saturday of May 2023 in your diary for a trip of a lifetime to listen to his wisdom.